Welcome to Conscious Capital, your go-to channel for insightful discussions on investing and conscious business practices. In today's brand new video, we delve into the wisdom of one of the greatest investors of our time, Warren Buffett. In today's episode, we'll explore Warren Buffett's strategies for identifying companies with sustainable competitive advantages through the interpretation of financial statements. Warren Buffett, one of the wealthiest individuals globally, has achieved his tremendous success by adeptly acquiring companies with sustainable competitive advantages. Notable examples include Coca-Cola, Moody's, and See's Candy. In this video, we aim to emulate his prosperity by learning how to identify companies with such advantages and generate profits. Specifically, we will analyze the financial statements of stock market companies, including the income statement, balance sheet, and cash flow statement. This Top 5 Takeaways video on Warren Buffett's interpretation of financial statements is authored by Mary Buffett and David Clark. Warren Buffett emphasizes the crucial importance of understanding these statements for investors. He asserts that financial statements are the language of business and goes so far as to say that those who do not comprehend them should refrain from investing in individual stocks. However, fear not, as Warren Buffett himself finds the process of digesting financial statements enjoyable. He humorously remarks that while others read Playboy, he immerses himself in annual reports. Clearly, his priorities are well aligned. Takeaway number 1. Consistency reigns supreme. Warren Buffett famously claims that the best investment holding period is forever. To illustrate the significance of consistency, let's consider a quiz. Which product do you think is more likely to remain popular in 2050? A. Coca-Cola, which has enjoyed popularity for over 120 years and has remained largely unchanged throughout its existence. Or B. Snapchat, which has been popular for approximately 7 years. The answer is evident. When Warren Buffett seeks investments with sustainable competitive advantages, he seeks consistency in various aspects such as earnings, low debt, consistent growth, minimal capital expenditures, and research and development costs. While evaluating the past 10 years provides a good starting point, the longer a company has demonstrated its durability, the better. Selling the same product for many years, as Coca-Cola has done, presents significant advantages for shareholders. It reduces costs substantially, including production, marketing, research and development, employee training, and the risk of obsolete inventory. When costs decrease significantly, shareholders' pockets become more lucrative. Furthermore, these companies enable shareholders to experience tax-free compound interest when their holding period is forever, a factor that has contributed immensely to Warren Buffett's wealth over the past half-century. Takeaway number 2. Warren Buffett's focus on the income statement. To illustrate Buffett's preferences, we will examine one of his more recent and largest investments, Apple. Assuming some basic knowledge about financial statements, let's start by examining the bottom line to confirm our previous discussions. Apple's net earnings have exhibited remarkable consistency over the past decade. Although it may not boast the same longevity as Coca-Cola, its products, particularly the iPhone, have retained a similar appearance since its launch in 2007. Furthermore, Apple's earnings have steadily grown. Another factor that Warren Buffett looks for in his investments is a consistently high gross margin, ideally exceeding 40%. Apple meets this criterion. Comparisons with competitors are also insightful. For instance, in 2018, Samsung's gross margin was 45.7%, while Huawei's margin was 38.6%. A high gross margin signifies business scalability, wherein increased sales lead to greater profitability. This trait is desirable in any owned business. Finally, comparing the bottom line to the top line and calculating the net margin is crucial. Companies with durable competitive advantages typically have higher net margins than their competitors. In this regard, Apple surpasses both Samsung and Huawei. As a general guideline, a net margin of 20% or higher is considered a robust result, indicating a well-operated business. Takeaway number 3. Warren Buffett's considerations regarding the balance sheet. Moving on to the balance sheet, Buffett pays close attention to a figure called retained earnings. This figure indicates whether the company reinvests its net income or not, with the amount being added to or withdrawn from each year. Buffett prefers to see steady growth in retained earnings, indicating profitability and the identification of lucrative reinvestment opportunities. Berkshire Hathaway's retained earnings demonstrate substantial growth over the past decade. While Apple doesn't quite fulfill the criterion for retained earnings, it's worth noting that since 2013, Apple has implemented an extensive dividends and share repurchase program. To assess how efficiently a company utilizes these reinvested earnings, return on equity is typically measured by comparing net income to the company's total equity. Apple exhibits strength in this area, partially due to distributing a significant portion of earnings to shareholders, and also as a sign of a business with a durable competitive advantage. In comparison, Samsung and Huawei are far less profitable. In his 1983 shareholder letter, Warren Buffett suggests a more sophisticated approach to evaluating a company's efficiency in using its capital. He recommends calculating the return on net tangible assets. For more details on this topic, refer to the essays of Warren Buffett. Additionally, a noteworthy observation is that exceptional businesses rarely require substantial debt for expansion, except perhaps in the case of banks. Typically, these businesses generate strong cash flows, which obviate the need for extensive borrowing. Thus, seek businesses with minimal long-term debt. If a company can pay off all its long-term debt with less than 4 years of earnings, it is in a favorable position. Apple clearly meets this criterion, as do its competitors. Takeaway number 4. Warren Buffett's focus on the cash flow statement. Lastly, we delve into the cash flow statement, which differs from the income statement as it reflects the actual inflows and outflows of money, while the income statement measures financial performance. Capital expenditures are a crucial figure to examine. These expenses represent the money spent on properties, plants, and equipment primarily. Ideally, capital expenditures should be as low as possible, preferably below 25% over a period of time. A figure below 50% is considered acceptable, with exceptions being made for one-time payments aimed at business growth. Apple performs exceptionally well in this aspect, consistently maintaining capital expenses below 25%. Its competitors, however, do not fare as well. Furthermore, examining the cash flow statement reveals why retained earnings have not experienced substantial growth since 2012. Apple has distributed a significant amount of cash to its shareholders. The augmented payout ratio, which encompasses share buybacks and dividends, has exceeded 100% during some years, indicating that Apple distributes more money than it earns. Takeaway number 5. Knowing when to sell. While Warren Buffett advocates holding investments indefinitely, there are 3 instances where selling stocks might be considered. First, when more funds are required for an even better investment opportunity. In some cases, particularly during bear markets, numerous opportunities arise, necessitating a shift from great investments to exceptional ones. In 1974, Buffett compared the situation to that of an oversatisfied individual in a harem. Second, selling may be prudent when a company's competitive advantage appears to be at risk due to changing times. For example, local newspapers with monopolistic traits are now being disrupted by online media. If any of your investments face such risks, it may be time to divest. Third, selling may be warranted during excessively volatile markets. Even a fantastic business can become a poor investment if acquired at an exorbitant price. Likewise, selling a fantastic business at a high price may improve personal finances, especially if you already hold such an investment. Warren Buffett and David Clark recommend considering selling stocks when the price-to-earnings ratio reaches 40 or higher, even if the underlying economics of the company remain promising. In summary, when seeking businesses with durable competitive advantages, consistency is key. On the income statement, look for consistently growing net earnings and profit margins that outperform competitors. When analyzing the balance sheet, consider higher return on capital, minimal long-term debt, and aesthetically growing retained earnings. When reviewing the cash flow statement, assess the business's ability to generate returns for shareholders by examining capital expenditures. Even outstanding businesses may warrant selling if funds are needed elsewhere, if their competitive advantage is at risk, or if the price is unreasonably high. These are just a few takeaways from Warren Buffett and the interpretation of financial statements. To explore more, consider supporting the channel by obtaining the book or exploring additional videos on Warren Buffett's investing strategy. Thank you for joining us on this insightful exploration of Warren Buffett's strategies and the interpretation of financial statements. Remember, conscious capitalism is about aligning your financial goals with ethical and sustainable practices. If you enjoyed today's video, Be sure to subscribe to our channel, Conscious Capital, for more valuable content on conscious investing and building a better world through business. Stay tuned for our next video, where we continue to explore the intersection of finance and conscious capitalism. Until then, may your investments thrive while making a positive impact.